Hi class, this will be the lecture PowerPoint for Chapter 3. In Chapter 3 we will learn how the adjusting process works and different types of adjusting journal entries. So these are our learning objectives for Chapter 3 to differentiate between cash basis accounting and accrual basis accounting. I do have a video on that as well in Blackboard under Course Content Chapter 3. Define and apply the time period and revenue recognition and matching principles. Learn number 3, explain the purpose of and journalize and post adjusting entries. Another objective, explain the purpose of and prepare an adjusted trial balance. Identify the impact of adjusting entries on the financial statements. Explain the purpose of a worksheet. Accountants love the use of a worksheet. We'll get into that as well. Adjusting entries and the adjusted trial balance. And this one, the appendix, we are not going to focus on. You shouldn't have any problems in the homework with the appendix. Okay, so the first thing, let's fill in these blanks. Let's see, after you've watched the video comparing cash basis accounting with accrual basis accounting, the main difference is timing. So for a cash basis, revenues are recorded when cash is received, and only when cash is received. So that is the cash basis of accounting. Let me change the font. Okay. Accrual basis, revenues are recorded when earned. That is the magic word, when earned. So not necessarily when the cash is received, it's when the revenue has been earned. So this includes all sales on account or providing a service on account. Okay, this results in accounts receivable. Okay, if a company uses the cash basis of accounting, the accounts receivable doesn't exist. Okay, under cash basis, expenses are recorded only when cash is paid. Okay, so really it's only when cash changes hands, is when cash is received and when cash is paid, do we record under the cash basis of accounting. Okay, however, it seems simple, and it is, but it doesn't apply the matching principle. So for that reason, the cash basis of accounting is not allowed under GAAP. It doesn't follow generally accepted accounting principles. So it is an easier method to follow. It requires less knowledge of accounting concepts and principles, but for that same reason, it's not GAAP approved. Okay? Under the accrual basis of accounting, expenses are recorded when incurred. So no matter if we have paid for an expense or not, if we've incurred an expense during that time period, we are to record that expense. Okay. The accrual basis of accounting is used by most businesses. It provides a better picture of the business's revenues and expenses. So let's put this example, let's put some numbers to it as a good illustration of the difference between cash and accrual basis of accounting. Okay, so on May 1, Smart Touch Learning paid $1,200 for insurance for the next 6 months. So if it's 6 months and the total was $1,200, that comes out to $200 a month. Okay. If the company used cash basis, the initial cash outflow was $1,200. See that? $1,200. So May 1st, cash payment made $1,200. If we paid $1,200 on May 1st, then if we use the cash basis of accounting method, we would record the expense for the full $1,200 because that is how much we paid. That was how much cash we paid for the insurance. Okay, that's again, this is if we were using the cash basis of accounting. The rent expense recorded would be the full $1,200, even though we have not used up all of that insurance. Okay, so the total expense recorded for the month of May would be $1,200. Now, in comparison to this one, look at the expense for May, $200, because we've only used up $200 for the month of May. It's $200 a month for 6 months. You see, the difference is this $200, if we're using the accrual basis, it's spread out over 6 months. It's matching the time period that we use that expense with the income statement. Okay? We're putting that expense on that month's income statement. We're matching the expense in that same time period that the expense was incurred. So hopefully that makes sense. We'll have, in the end, the total expense will be the same, but it's the timing. For the accrual basis, again, we're expensing $200 for the month of May because $200 was used or incurred. We're expensing $200 for June because $200 of that insurance was used or incurred. Same thing, and that goes on, okay? On April 30, Smart Touch Learning received $600 for services to be performed for the next six months, May through October. So this is an example of cash that has been received for services to be performed for the next 6 months. So for cash basis, we would record the entire $600 for the month of April. So all $600 would be on April's income statement as revenue under the cash basis. But under the accrual basis, we're going to spread that revenue out for 6 months. Okay? $600 a month, or sorry, $600 total for 6 months, that's $100 a month. So we would perform services for May, earning $100, performing services for June, earning $100, for July, earning $100. Okay, so for every month, we would have $100 on the income statement as revenue. It's spread out over that time period. Okay, now we're going to go over some accounting principles and concepts that are introduced in this chapter. The time period concept assumes business activities are sliced into small time segments, and that financial statements can be prepared for specific periods, such as a month, a quarter, or a year. Okay, the next one, a fiscal year is an accounting year of any 12 consecutive months. It may or may not coincide with the calendar year. So a fiscal year is an accounting year of any 12 consecutive months. So if a company has their accounting records and they end their year, let's say on June 30, a lot of times the military or government organizations will have a year end of June 30. Well, that's not the date that the calendar ends, so we call that a fiscal year. Basically, a fiscal year end is any time period that ends on any date other than December 31st. If it ends on December 31st, it's the calendar year end. Any other date, and it could be anything, it could be the end of January, January 31, then we would call that a fiscal year end. Okay? All right, let's go over the revenue recognition principle. The first step is to identify the contract with the customer. Okay? The revenue recognition principle tells accountants when to record revenue. And it is a 5-step process. So the first step is identify the contract with the customer. So a contract is an agreement between two or more parties that creates enforceable rights and obligations. Okay, step 2 is to identify the performance obligations. What are we obligated to do for this customer, okay, for this contract? If we're cutting grass, are we obligated to do it once a week, once a month? What is our obligation? What is the price? Okay, so a performance obligation is a contractual promise with a customer to transfer a distinct good or service. Okay. Next, step 3, determine the transaction price. What is the price? What is the amount that we would receive, from, mowing our neighbor's yard? Okay, under step 3, the transaction price is the amount that the entity expects to be entitled to as a result of transferring that good or service. So as a result of us, our company cutting our neighbor's grass, what is the result of that? If we do that service, how much are we going to receive? What will that revenue be? What X amount? What dollar amount? Step 4 is all filled in for you. Allocate the allocation price to the performance obligations in the contract. If the contract has multiple performance obligations, the transaction price will need to be allocated among the different performance obligations. Okay, and we will get into that in a little bit more detail in a later chapter. Step 5, recognize revenue when the entity satisfies each performance obligation. So this first bullet point under step 5, the blank is by transferring. So the business will recognize revenue when it satisfies each performance obligation by transferring a good or service to a customer. A good or service is considered transferred when the customer obtains control of the good or service. If it's a good, when they obtain control of that good, when they have that good in their possession, when a good has been delivered, for example. The amount of revenue recognized is the amount allocated to the satisfied performance obligation. All right, now let's go over the matching principle. The matching principle guides accounting for expenses, and it ensures 2 things. All expenses are recorded when they are incurred during the period. So not necessarily when the expense has been paid. For example, if we've got a utility bill, that we received in the mail for the month of June, well, it may not be due until July, but since we used that service, since we had our lights on for June, we need to record that expense now, at the end of June, to make sure that expense gets recorded on the income statement for the month of June. Okay, so expenses are matched against the revenues of the period, and the goal is to compute an accurate net income or net loss for the time period. Okay, so because we were in operation in the month of June, we served our customers for that month of June, we were in our office space in the month of June, we did receive revenue, we earned revenue, and a big help to that is by having electricity in our building. So we're going to match the expense for the electricity and the revenue earned in that same time period. Okay, we may not have received all the cash from our customers for the month of June, but remember, we're using the accrual basis of accounting. So we're recording revenues when earned and expenses when incurred. Okay, that goes back to our earlier